Hi, everyone. Thank you for joining. We'll just give it 30 seconds or so to let people come in before we get started. Okay, we've got a lot to cover, so let's go ahead and get started now. So once again, thank you all for joining and welcome to our webinar on project finance for the durable removals market. Today, we're joined with an incredible panel of experts on, both sides of the equation. We've got those companies funding the projects, and we've also got a company here who's successfully raised funding multiple times in the past. I'm Adam Sitthorpe. I'm head of CDR sourcing for the Europe, Middle East, and Africa region at Carbonfuture, and I'll be hosting a discussion today. At Carbonfuture, we specialize in bringing high quality, durable carbon removal projects to market. We have two main software products to help us support the suppliers in the industry. One being a digital monitoring, reporting, and verification product called MRV Plus, which should enable greater transparency and efficiency to get the project certified. And we also offer our marketplace services, which helps our suppliers to find bankable offtakes for their credits. Now, before I hand it over to the panelists to introduce themselves, I just wanted to take a couple of minutes ahead of that to set the scene and explain why we wanted to host a webinar on this topic today. As Carbonfuture, we speak to as many suppliers as we can, and it's a crucial time what we're learning for the carbon removal market with a lot of proposed projects, but many who have yet to receive funding for their projects and are going to need to find funding to be able to buy the equipment and begin to build their projects. This discussion is aimed to provide some insights from the amazing panelists on what type of funding may be available and what you all as companies actually building the projects can do in order to try to increase your chances of success. We'll also be releasing a guide in a kind of a PDF form at the end of February, where we'll go into more details about the different funding mechanisms available in a more kind of step-by-step way to look at project finance. But today is more of an opportunity to hear from the experts themselves, what to keep in mind and try to shift the topic away from project financing being an overly complex task that feels like it requires all of your time in order to get anything done, to something that's a little bit more actionable. The CDR market and finance markets are pretty similar, that they're full of jargon. We'll try to keep as much of the jargon out as possible and keep it, to the questions that you've asked going on. So if you didn't have a chance to ask a question during the time you registered, please feel free to add it now using the Q&A feature of Zoom, and we'll take some time at the end of the call or throughout this call to add these to the Q&A. So then we can get to the most pressing questions for you all. But before we introduce the speakers, I just wanted to ask a question to the audience. Where are you in your project financing journey? And if we can, I think we should be able to put a poll up now here, so that you should be able to submit your answers there. We'll give it 20 seconds or so for you to submit it. And then the panelists can keep this in mind as well when they're answering it. So be quick because we're going to cancel it. We're going to close the poll very soon. And maybe you can close the poll now, Kevin, and we'll keep that in mind. And if we can see the answers, that would be great. Okay, so most are at early stage and haven't contacted anyone about financing yet. That's 45%, and then 26% is currently in discussion. So it sounds like we've got the right audience here, and the panelists are going to be able to give some really good insights into this topic today. So without further ado, let's begin to introduce the panelists. And for each of you on the panel, please spend a couple of minutes talking about your role, your focus, and why your company is interested in working in this sector as well. In no particular order, maybe I'll start with Jeremiah. So we have here Jeremiah Lim, Director and Head of Carbon and Sustainable Fuels for the EMEA region at Barclays. Jeremiah, can you give a quick intro to yourself and Barclays' involvement in this market?
Perfect. Thank you very much, Adam. Lovely to be on this panel with my esteemed kind of panelists. So Jeremiah Lim, I'm a director in Barclays. I lead our carbon and sustainable fuels investment banking practice, which focuses on kind of providing capital, both in the form of debt and equity to carbon dioxide removals projects, carbon capture, transportation and storage, which is the underpinning infrastructure behind CCS and CDR, as well as utilization of carbon in sustainable fuels like methanol, sustainable aviation fuel, and others. It's very much a franchise that's been built from ground up to be focused on carbon management, as I call it, in shorter terms. And we've kind of designed the products we focus on very much with the industry in mind. So figuring out how to help developers and technology companies find out the lay of the land within the institutional financing world, whether it's project financing, small P, small f, which we'll get into, securitization, structured equity, or any shape or form of that. We try to help companies on the journey from getting a first of a kind project up and running. That's typically where we get involved in at the earliest, all the way to getting them to scale and moving millions of tons of CO2 either from a flue gas or directly from the air into a saline aquifer or depleted gas field underground. So
Great.
Lovely to meet you and looking forward to the conversation.
Thanks a lot, Jeremiah. And do you have a specific set of technologies that you look at, or are you looking at across the whole durable removal and wider CCS spectrum?
Yeah, I think we're quite broad in the form of technology we look at. It's mostly based on the specific techno-economic analysis of the pathways. I can share that, based on the public announcements, at least you can see we've invested in kind of a direct air capture company, Origin Carbon, which we just closed a couple of weeks ago. Calcination-based technology. We've also invested in kind of soil organic carbon company and the metal organic framework carbon capture-based technology. On the financing side, we've provided debt financing to Northern Endurance Partnership and Net Zero Teesside, the two major projects in the UK, and various other CCS projects as well. So we're not we're fairly agnostic as to the pathway, but it really comes down to the techno-economics of the specific projects.
Great, thanks a lot. And then next, I'll pass over to Linda Alami, a global carbon associate at Macquarie Group. Linda, can you explain a bit about your role and how Macquarie is viewing this market as well?
Hello, and thanks for having me. I think it would be a bit similar to Jeremiah, but a bit different as well. So for those who don't know, so Macquarie is an Australian bank, but we operate globally. So we're mostly known for our infrastructure and commodities businesses. So I sit in the commodities division, and I look at financing or investing in a carbon or energy transition related projects or companies. So we've invested in a few, voluntary carbon projects in the past, some, cook stoves, savanna management, carbon capture. But because the voluntary carbon market has been a bit challenging over the past couple of years, we've started to look quite a bit at the CDR market, specifically because we saw some signs of policy support, and because of some bad press, let's say, around some carbon projects, we thought it would be perceived as higher quality projects, in terms of permanence, for instance, and for some technological CDR, technology-based CDR, it's a bit easier to ensure traceability of the CO2 removed. And we've seen very interesting technologies, very, very long or permanent storage potential. And what we try to do is, so for instance, to quote with Jeremiah, we don't really do super early stage, first of a kind projects, but we look at technologies that are proven. We like when it's a bit like low technology, there's low technology risk, and we want to help developers scale up. So we kind of just come like a bit after that, and then there's a lot of overlap with that, what Jeremiah just said. And Yeah, in terms of what we've seen a bit like challenging the sector is also the policy clarity and a lack of clarity on timing. That can be impacting demand from corporates or buyers generally. We can see that in the CDR market, the demand is coming from only a handful of buyers, and a lot of dominated by like one major buyer. Yes, but we have a few criteria we look at when we look at projects, but I think we can come back to that a bit later.
Sounds good. Thanks so much for the intro. Next, I'll pass over to Greg Stangl, who is the CEO of Phoenix Energy, who are building, owning, and operating on-site biomass gasification plants, including operating a biochar project. Greg, can you tell us a bit about your company and your pretty amazing experience with raising capital in this space?
Yeah, 100%. So we, as Adam said, are in the build, own, operate space of community scale biomass gasification assets. So I think we built our first gasification project in Europe in 2003. We got set up here in California in 2007. Started making power and biochar in 2010. And so my smart alecky comment is always, like, shoot, we've been carbon negative since, pretty much we got started in 1999. Nobody wanted to pay for that until like Thursday. So that's just been, CDR has just been a remarkable thing that's kind of helped us with COVID kind of kicking everybody in the teeth and making everything 50% more expensive. That sort of really kind of coincided with when the carbon benefits of what we do became not just valuable, but sort of, suddenly mission critical. But yeah, that's us. So we're out on project number 5 here in California. And project number 4 is just started the cold commissioning process. So pretty excited about that.
Great, thanks a lot. And have you found that the way of raising capital has changed much across this time period?
Very much so. Very much so. And I'm sure we can get in this. In the beginning, EPCs were like, gas a what? Like no idea what you're talking about, like bio what? And so in the beginning, we did a lot more sort of scrappy, guerrilla finance of a lot of creative vendor finance, which is just always a double-edged sword. Like, but that it has evolved, as you might expect, as the market has matured into, regular sort of, bank deals, tax-exempt bond deals, just along those lines. So it really has become a lot more mature in the years since we built the first plant in California in 2010.
Great, thanks a lot. And I'd love to drill into that in more detail in a bit as well, because I'm seeing similarities to what Linda was mentioning there and where Macquarie get involved. Great. And then last but by no means least, we have Erica Vetzwille. Definitely didn't pronounce that right. I tried my best. Managing Director thank you. Managing Director at Terra Natural Capital. Can you explain a little bit about the approach of Terra Natural Capital for this market, and where do you see the market heading as well in the coming years?
Great.
So just the easy questions.
Perfect. So firstly, thanks to Adam and the Carbonfuture team for having me. So as Adam said, I'm one of the founders of Terra Natural Capital. The team behind Terra, we've built our careers over the last sort of 10, 15 years, very much focused on early finance into commodities linked to decarbonization, which feels very, very niche, but essentially looking at those sort of hockey sticks of demand, think front page of The Economist type, electric vehicles, renewable power, et cetera, and then looking at the supply chains behind them and trying to link what supply is needed to unlock that demand. We, as an example, we would design sort of the initial or first project finance facilities into the first lithium, greenfield lithium assets. Same with rare earths processing, ex-China, and cobalt as well. One time we had the largest portfolio of conflict-free cobalt globally. So this was back in 2015, 2016, all of these markets where if you told someone you were investing in EVs in 2015, you got a lot of strange looks back in terms of like, are you sure everyone's going to be driving Teslas? Everyone had their doubts. And now, of course, we see Teslas everywhere, and a lot of these commodities are household names. We started looking at carbon probably in 2018, 2019, starting where most funds start in the compliance markets, and then transitioning slowly into what I call project-based carbon. And so, yeah, activities that either reduce or remove carbon emissions. Of course, there we saw direct analogies to a lot of the other markets we worked in and have successfully invested in. It's not sort of no terminal end market. It's not hedgeable in any way. There is some process or delivery or technical risk underpinning it. Very hard for institutional investors and banks to get behind these markets in large ways. Very much lacking those initial precedents or initial investment success stories that's going to really sort of catalyze capital into this space. The projects, of course, hard assets, long sort of duration investment or capital is required, and certainly that time to first cash flow can be long dated, as well as most importantly the demand signal. So drawing lessons from these earlier markets, very much focused now on designing investment or finance solutions that service, of course, the project developers in the space, but also the investors, and sort of structuring risk and opportunity in such a way that people can confidently step into this market, and then servicing the demand, of course, as well. So looking forward to getting into that.
Yeah, thanks a lot. And then maybe if we start on the Q&A, or just before we start on the Q&A, I should say, Jeremiah, I've heard you speak a few times about project finance, and maybe, although we called it project finance here, we're not always discussing what a bank would consider project finance with a capital P and a capital F. Can you explain a little bit about how you view project finance versus the financing of projects, let's say, and is there a big difference between those two terms?
Yeah, absolutely. And I think you've hit the nail on the head. When you say big P, big F, project finance, there's a kind of generally industry accepted terms for that, what that means. That generally, if you speak to a banker like myself or Linda, they generally immediately think to LMA, Loan Market Association standard contracts, and so on, right? So they're standardized terms. And the reason for standardization is really for liquidity, right? When you syndicate a loan or when you trade a loan, people want to know what the terms of those loans are. So when you have a bespoke contract, it takes a lot longer to underwrite the individual terms of that contract, and therefore reduces the liquidity, the amount of people who are willing to look at it and willing to buy it, or receive a syndication of that loan. So when we differentiate big P, big F project financing from the financing of projects in small letters, really we're distinguishing what's a standardized product that's been created for infrastructure type projects, typically on standard terms, from something that's a bit more bespoke, but still a non-recourse style financing to a project, greenfield project that's bankruptcy remote, ring fence from its parent. That's kind of more, the latter is more of the nature of products that we're seeing kind of successful executions with the carbon dioxide removals market, and certainly that's kind of the nature of product that I'll recommend suppliers of carbon dioxide removals credits think about in the, at least at the early stage of your project development. The key difference here being that, you know, when you enter into the financing of a project that is not on standardized terms, it requires a lot more work from someone like myself and Linda. So it's bespoke structuring of complicated assets, trying to understand and underwrite the risk around it, and to Erica's point, really negotiate a fair risk allocation that's not pre-baked, right? So there's no standardized way that people understand the risk allocation on the CDR project today. There are no kind of standardized offtake contracts. If you go to an engineering, procurement, and construction company, they're not giving you a full wrap EPC, right? You see in a wind farm or something like that. And equally, the technology provision contract might not be as ironclad as you would see in other industries as well. So there's a lot of finessing the contracts around who's willing to bear what risk, and therefore how you can structure it in a way that a lower cost of capital provider like us banks are willing to come in and provide capital with the right risk adjusted returns. So yeah, that's kind of the distinction I'll make up front as we're talking about it. Today's conversation is very much focused on small p, small f, or the financing of projects.
Thanks a lot for going into that. And if I'm thinking of it as a supplier now, all of this sounds very long. So what can a supplier do in order to get themselves lined up and ready to be in this position where they can go with a small p and a small f to you or Linda or to Erica, and to remove as many wrinkles as possible and to try to streamline it as much as possible?
Contracts, gotta have contracts.
Contracts, okay.
We finance contracts. I mean, we finance a box full of contracts, and whether that's a contract for fuel, offtake, there's a giant infrastructure fund who shall remain nameless during this entire conversation, who offered us more money than you could ever possibly imagine, could not, in the end of the day, get comfortable with what exactly biochar is and how come we don't have a 20-year offtake for it. And so that, that deal never happened, but we finance a box full of contracts and a track record when we go to market.
I see. So this contract doesn't necessarily need to be the credit sales necessarily. It could be the heat, for example. It could be the biochar, physical biochar sales, whatever the product is. It just you need to see some kind of as close to guaranteed income as possible. Is that right?
Yeah. I mean, it would seem that the more appropriate opinion is really Linda and Jeremiah, but for us, obviously you also need to bring your tap shoes, but like the easiest part of our business is, let's say we'll get a power purchase agreement with a utility, right? That's pretty plain vanilla. That's pretty ironclad. It's a 20-year deal. Nobody much questions that. When it comes to an offtake contract for carbon credits, that's when you need to put your tap shoes on and you do a little bit more explaining. And every time you have to explain, that's sort of like a mark against. And so what we're always trying to do is have to explain as little as possible and, let the contracts do the talking for you. And whether that's on the cost side, known costs, like fuel, for instance, is a big one for us. But having as much of the project as you can papered in contracts and having the fewest little holes that some person can push their finger right through your paper tiger, the better.
I would completely agree with that. I think we're at a point in the market where most investors would agree on the upside. Do you know what I mean? That's crystal clear. It's the downside, this risk of what are your known unknowns and unknown unknowns. There's been a lot of zeros in this market, right? Whether you're talking broader carbon markets or even CDR, everyone's terrified of the idea of stranded asset risk. And I mean that on the supply and the demand side, right? We've seen demand tastes evolve. Do you know what I mean? Every 6 months, there's a new standard on what's the right credit and what's the wrong credit. And so we just want certainty. And that certainty does not even have to be that exciting because you'll leave enough on you'll leave enough upside optionality that you'll kind of get there. It's de-risking, those lines of the financial model, those like the business plan, and how do you de-risk in the eyes of the investor. It is really contracts.
So it sounds to me though that contracts are both the opportunity and a bit of risk, right? Because a poorly designed contract could then almost be worse than no contract.
Yeah.
Is that right, Jeremiah? Would you see, or Erica?
I mean, I think the key thing that kind of, you know, Greg and Erica mentioned, which is really kind of the perspective of the financier, is that, you know, in the ideal world, again, going back to the big P, big F project finance example, where it's a really low cost of capital product, right? It's a standardized, really low cost of capital product. That product was initially designed to finance toll roads. And, you know, the kind of the point of it financing toll roads is really that there's a very well understood income stream, cars passing by a toll that get charged. Where you have a pretty good certainty around what the cost to maintain the toll booths are and how many cars are passing through on an annual basis. And that is a very good basis for an income stream that has very little volatility. And ultimately what, you know, Erica and Greg mentioned is really about how do you stabilize the volatility of your cash flows, right? How do you make sure that there's as little changes as possible, and what can you allocate to someone else, you know, pay someone to take on risk, or, you know, or vice versa, in a way that gives you buffer and reduces the volatility. That ultimately is kind of the gold standard we're going towards. Every step away you get from a toll road or a mortgage or something like that is something that, you know, we have to risk accept and underwrite, or try to squint, candidly, right? Every kind of, you know, every step in the techno-economic analysis you do is a step that you have to convince yourself will be true. And the more things you have to convince yourself that it is true, the harder it is to make that investment and convince the investment committee that that risk is manageable or has even some big, you know, substance behind it. And on top of that, you have a business model that isn't really kind of as liquid as one would hope, i.e., you know, even if you argue that, you know, carbon removal credits are worth something, there is a significant bid-ask spread in liquidating those credits today. So the security package that you get, that's the other angle that you're thinking about, apart from cash flows, is not liquid enough for you to kind of stabilize your cash flows or take confidence in it, in the way that an asset financier, like if you were lending against a car or a property, like somebody's house, you would take a lot of security in the liquidation value of that car, right? Because it's a very liquid traded asset. In CDR today, until we reach the point of liquidity, that's not really the case. So you really have to do a lot of homework around underwriting. Is this a good quality credit? Can I take comfort in certain liquidation value coming arise? Or is it worth zero if the developer of those credits goes insolvent? Because that's the downside case Erica was mentioning, that we're solving for. So it's really kind of stabilizing all these risks and getting it to look as much and smell as much like a fixed cash flow stream as possible. And that's what will generate the most interest from the financing community.
Okay, great, thank you. So Linda, maybe coming to you, from a supplier's perspective, where should they start? It sounds like this is a very, there's a lot that needs to be done before it's ready to get to project finance, right? And is the place to start looking for, of course, expecting the project execution plan to be robust, is then the next step to reach out to someone like yourself to understand the requirements from your side? Or would you rather say, no, speak to off-takers, speak to somebody who can give you a contract for whatever, be that credits, be that some other revenue stream, and then come back in a few months' time?
So it's a bit there's no like set answers, because it's a bit of chicken and egg situation all the time. So I would say it's better to start talking to off-takers to begin with. I mean, I think everyone mentioned that contracts are key, but it's a bit, some off-takers want to see that there's someone backing them as well. I mean, have had this feedback from project developers as well. So I think it's like you don't want to go too early to financial institutions where you feel like you actually not ready, you have nothing, your pitch is not very well defined, you have no revenue secured, and it's really hard to seem very credible So I think it's a bit, you don't need to have like everything ready, but you need to have conversations that are advanced enough that you can, you can try to convince them that you're a good horse to bet on. But eventually you will need enough certainty around the cash flow generation for them to get the deal approved. And also I think can keep in mind that like different institutions have different risk appetite for different, like items. So for instance, like I mentioned, the technology risk for us is a bit tough, but other, VC, like venture capital funds or impact, I mean, it depends on their investment strategy. So depending on what stage you're on, you should target the right institutions to approach. So for instance, if you have a new technology that you've developed and it's really cool, so you want to get financing for that like a project that uses that technology, Macro, it might not be the best one to talk to at first, but other funds are really keen on trying this new technology and think, oh, there's a really good IP around, like there's a lot of IP around this technology. So I think you need to target the right people, and then once you have like de-risked a bit the technology, for instance, you could come to us and say, okay, we have approved that this is working, and then the contract bit will have to go, like you have to go through that again for each project. So that's a bit, some things you have to do from scratch for every project, and some you can build on with track record, your experience, and then
So it's also a bit of an art, right? It's about reaching out to the right players at the right time in this situation. And Greg, I'm sure you've been through this.
I'm dying to get in there on that. Yeah. And look, the only reason we know is because we reached out to all the wrong players at all the wrong times. I mean, it's just getting your head knocked in that you figure this stuff out. But yeah, like Linda's point was just so amazingly accurate, which is you have to know who the money is. Like these people raised money based on selling to their investors a certain set of criteria and goals. And those are really different for different people. We've actually had infra funds who were like, if you show them too much of a return, they don't want it, because that means if the return is that high, that means we're taking more risk than we told our people we were going to take.
Wow.
So really, like, it should not be underestimated that you really need to do your homework on the people that you are approaching for capital to kind of minimize the number of frogs you have to kiss before you find your prince.
And I think it's
go ahead, Linda.
No, just to build on that, is sometimes you don't want to use your arrows at the wrong time. So it's because if you give not a bad impression, but more like that you're not ready for some players, then you're like, well, it's the team that has that kind of have like a bit like average presentation, but it's not that it's just they were not ready because they didn't speak to the right people at the right time. It doesn't mean that the team is bad, or like it's just calibrating that who you're talking to at the right, like at what time.
Yeah, I'll give you a great example of how I did it the wrong way. So in one of these big funds, they were like, okay, well, look, you've got to go out and we can't take biochar risk. This is before carbon credits were a thing, right? So about 80% of our revenue came from power, 20% of our revenue came from the sale of biochar. With a 10-year track record of selling it, nobody cared. Nobody cared about a 10-year track record. They wanted offtakes. And I'm saying, like, there's no such thing as an offtake. And they were like, you're a talented guy, go get us an offtake. So I went home and I called my best guys in the garbage industry and I said, I need an offtake. And I wrote it for them. Like, here's the LOI. And I got 3 of them to sign it in 24 hours. And then I went back and said, okay, you asked me for LOIs. Here are 3. And that was the death knell, because they're like, well, wait. I mean, if you could just snap your fingers and do this, how come you didn't have it the day before yesterday? And I basically got myself laughed out of the office. And I felt mildly embarrassed about that. But that it's just got to do your homework. You got to know who you're talking to, and you got to know what their hot buttons are before you kind of got to know what the answer to the question is before you ask it.
Can I ask maybe a tough question here, Greg, and let me know whether you can speak about this as well. But I'm assuming taking on finance also brings risk to your business, right? And how do you assess the need for project finance versus the risk that it puts on the top co or on the company?
Yeah. And I think this is another thing that we've probably done wrong, because over the years, it's been like, well, you can say, look, there's a certain amount of desperation that every operating business is in, because if you don't get the capital, like, you can sit there and talk about having the right capital or the best capital, or, twiddling my thumbs for the next 20 years before we get plant number 1 on the ground. But there are certain challenges we've had where, okay, vendor finance is kind of like the easiest capital to get, because we're not inventing a mousetrap, but most of the people are very anxious to get their gear out there. But you find that they have 2 ways to make money on a deal, and you only have one. And that one time sort of blew up in our face with this thing that I didn't even know was a word in the English language, called change order. And you get into a deal and you suddenly find out that your source of vendor finance just got more expensive by the amount of vendor finance they gave you, right? So there can be some surprises like that. And then obviously, look, debt is risk, right? It's enticing because it's a cheaper cost of capital, and depending on the nature of your cash flows, it can actually be much easier to secure. But if you don't see COVID coming, if you don't see California wildfire coming, if you don't see, like, I did not see GE's thermonuclear meltdown coming. And I thought having a deal with GE was like, made me like an awesome guy. And that, even that thing totally went sideways. And I did not see any of those things coming. And when your capital stack is got a lot of debt in it, those things become pretty tough to overcome, because there's a lack of flexibility with debt. They're not planned to be flexible.
Yeah, and I would add to that, right, Greg? When whether it's debt or equity that we're investing in a company, typically there's a degree of, as an institutional investor, we're expecting a degree of financial discipline that has to be instilled in the company, right? So you can't run yourself like a self-starter family office, etc. Anymore. Once you take in institutional capital, that institutional capital will instill some degree of discipline, reporting, understanding what your cash flows are, and putting metrics around how you spend your money. Because ultimately, you're no longer spending your family's money or your founder's money, but you're spending the bank's money, right? And there's, that's not always the right answer for every single investment out there, or every single company out there. There's a stage in maturity in which that is a enticing proposition, either because you're building a large scale project that you need financing for, or you've reached a point in the company's life cycle that you think a degree of operational efficiency and instilling some of that discipline is value add to the company rather than value accretive. So, there's always the right time and right place for these things, but Greg raised exactly the right point, that when you are taking on debt or equity, any form of institutional capital, that comes alongside that need to structure your company in a certain way and run your company in a certain way. And that's only right for companies that have a certain maturity and reaching really what we consider a kind of that growth scale-up phase, rather than testing out a new business model. Because when I make an investment, I'm making an investment on a business plan that I've underwritten based on a techno-economic analysis that I've underwritten. If those things are moving, I'm not investing, right? And if you tell me after I've made my investment that you want to change that, that's a big problem, right? It goes back to IC, there's many of these kind of like structural challenges. It might not be a good fit for the mandate. We might need to sell down in the worst case scenario, or exercise some of the rights that we have negotiated as part of the investment. So yeah, it's always a double-edged sword. There are no solutions, just trade-offs.
We've just had a question come in related to this actually from Romani. For a project at pilot stage then, what kind of financing options would you recommend for a project at that stage? I'm assuming it wouldn't necessarily be a Barclays or a Macquarie. It may be a bit too early stage for that. But how would you recommend they get that funding to get their projects off the ground?
I mean, the very simple answer to that from my perspective, and love to hear my kind of colleagues who are on the coal face of this, right? But, from our perspective, is an institutional capital you need for a pilot project, especially if it's demonstrator or what have you not, is very much philanthropic grant capital. And that's the best answer you're going to get because ultimately it's non-dilutive, right? So somebody's giving you a grant to test something out, and to prove out a thesis. Once that thesis is proven, like even the next stage might not be institutional capital ready, right? There has to be a lot, like when Linda and I look at a project, it's got to be kind of tested at a systems level, right? Not just your technology stack that your proprietary equipment is meant to cover, right? It's not a lab test, it's not a demonstrator, it's a full systems sub-commercial level plan that we underwrite. So it's probably kind of multiple steps away from institutional. But Greg,
Erica, if I could...
Erica from the coalface.
Am I at the coalface? We're probably to be fair, we're probably analogous to, so in terms of the technical risk we're ready to underwrite, on the durable CDR side, I would say at this time limited, right? In terms of we need to see that the technical case demonstrated, right? And we need scale up. We need really confidence in the scalability from pilot through to sort of the full capacity, so to speak. Where we can lean on and where there are exceptions to this, and I'll draw an example from nature-based removals, is the role of insurance in this market. And I would say insurance has shown up in a big way in terms of trying to bridge when we talk about sort of risk sharing tools. Insurance becomes a very important piece of the puzzle for us. And so in nature, I think everyone can agree sort of timberlands, eucalyptus can grow everywhere. The real question in nature-based carbon removal has been native species or ecosystem restoration, and how confident can we be on the carbon sequestration curves that those projects can underwrite. No one has done this at scale before. Yes, there are pilots everywhere at 1,000 hectares, but translating that to 10,000 hectares in the global south is another question altogether. This is where insurance, this in other markets, whether they're insuring agriculture, timberlands, or parametric insurance, do you know what I mean, for smallholder farms, the same risks that can impact a native species ecosystem restoration program are the same as risks that have been underwritten in by other insurance products. And so we've been very much, I guess, drawing on these products, working with the insurance companies to amend them to carbon projects, but we've seen a lot of traction to date. So when we look to building that bridge to durable CDR, a lot of the insurance companies are starting to look at, again, the lower end of the technical risk curve, but that's happening, and then I think that can be a very powerful tool for investors to start being able to underwrite sort of earlier stage projects.
I'd love to drill in a little bit there. Because the different insurance models out there for durable removals at the moment vary quite a lot. And would love to hear from the whole panel here. What is the model that from financing a project's point of view is most attractive? Is it one that covers under delivery risk? Is it one that pays out in equivalent credits if the project does not issue as it was expecting, or is it one that pays out in dollars? What kind of insurance is the most attractive from an investor point of view or a financer point of view?
We all always seek, for now, insurance paid in dollars. I think it's difficult to, again, as much as we all wish and hope that one day carbon is a commodity, it's absolutely not a commodity. So each project is so bespoke that, I mean, essentially it's a service, right? And who are you providing that service to? In permanency, it's durable CDR, that's your off-taker, yeah? And so you're promising the developer standing behind that idea that I'm delivering you not only a carbon credit, but one of certain permanence and integrity, so to speak, yeah? Now, insurance paid in kind does not help me if my off-taker is not going to take that in kind, right? Because now my hedge, my market hedge has fallen away. And so for us, for now, until sort of the broader ecosystem can accept fungibility of CDR and we can draw a line under the sand of what that fungibility is, yeah, the insurance paid in dollars is where our focus is.
But as the developer here, I'd say we're the other arm in the arm wrestling match. And you want to try and do as little of this as possible because it's really freaking expensive. But it is a great place. We talked about before, you're trying to, you've got this wireframe of a tiger and you're trying to put as many sheets of paper on that wireframe as you can. And in areas where you just can't, insurance are amazing products. So for us, it was fuel, right? We're in the forest. It's a 3 megawatt plant. Like, are you flipping nuts? I need to convince somebody that there's enough wood in a forest to run a 3 megawatt. Like, for me, that was like, what are you talking about? Where'd you go to school? But yet, why can't I get a contract for that if it's so obvious? And so we were able to do that with an insurance product that paid not in dollars but in fuel, so that if we can't, like we could find other people, not the investor, but other people who were willing to take the risk that there's wood in a forest and it would be available. Like a lot of people don't realize when there's a fire, it actually makes more fuel for us. There's lots of big giant trees sticking up with no branches. Like that's our fuel. And by the way, government forgets that it wants permits for that stuff when there's a fire. They just go in there with a D6 and they knock all that stuff down. So it was an easier place for us to fit an insurance product on top of that to make investors comfortable with fuel risk. Like, prove to me that you're going to have fuel for that cute little power plant of yours in year 18. How do you do that if you can't, wood chips are not pork bellies? Like you can, there's no such thing as an 18-year contract for wood chips. How do you address that risk? But, technology risk policies or other things we can get. And for some reason, they all come out of London, even though we're in California. And you don't want to talk to Californians about insurance right now. It's a very sore subject out here for like the 2 insurance companies that we have left in this market. But it's a super way to help bridge what seem like unbridgeable gaps between you and your investor.
So I would just, sorry, as the investor, I mean, when Jeremiah earlier spoke about sort of the maturity of the business model, I think a lot of project developers also on the nature side take for granted the idea of you're running a company. If I were financing a wind farm, I would expect you to take your own insurance out. And this carbon insurance has been designed for investors or corporates who are prepaying. Yeah, the pricing comes materially down when the project itself has its own insurance. And so by no means do we mean like there is a cost element of insurance. We don't need to be double, triple, quadrupled insured. The idea that the investor needs insurance is because the underlying products are so often underinsured. And when we think about security packages, do you know what I mean? Like if that security package is not insured, it's in itself, then yeah, I need to ensure my capital going in. And I think those go to and like absolutely come together.
We had a nice question from Tara in the comments as well, asking whether you could, if a tech provider has a turnkey guarantee, can this act as somewhat of a techno insurance for the project, or is this not
I'm
really
happy to
helpful?
cover that. So she's basically, they're referring to, you know, in an engineering, procurement, and construction contract, EPC, there's a concept called kind of lump sum turnkey, which is effectively, we'll give you the keys to the project. We're done, right? You pay us a lump sum and you get the keys to the project. We're on risk for everything. The problem I've seen with a lot of these contracts is, if it genuinely is a lump sum turnkey contract, great, right? If it's from a reputable EPC that has a balance sheet to back that, that's great. Often what we see is that it's not. So they might say that the balance of plant is turnkey, but we're not taking on the risk of the key, you know, technology stack, whether it's a carbon capture stack or the direct air capture stack. You're on risk for it, or the technology provider is on risk for it. Or they might say that, you know, there's an element of risk that we're providing a turnkey solution for, right? That's the term of the news. And usually in the CDR world, they're saying, I'm providing a turnkey solution for the compression or the liquidation or liquefaction, sorry, or the transportation, right? Injection into a pipeline or what have you not. But it might not necessarily be for the DAC unit itself or the BAC unit itself. So if it's genuinely a lump sum turnkey, yes, it does help with CapEx overruns. It doesn't fully solve all the other risks that we've talked about today, the offtake risk, the revenue risk, your feedstock risk, so all the inputs that you need to go into your CDR plant, whether it's power or fuel or what have you not. But it does solve for the element of construction risk that you know, developers and investors are concerned about as well.
And we're running out of time because we've had such a great discussion. So let's try and keep this one brief, but would love to hear from Linda, Erica, and Jeremiah. Geography. Now, Greg is in the US, which is pretty stable economy, globally leading economy. How about projects in the global south? Are you assessing these in the same light, or do you have a different set of criteria on how to assess these projects? Because of course we want to scale projects globally and not just in the developing world, the developed world, sorry.
Well, so we've been talking a lot about demand. So, I mean, to be fair, for CDR, like regulation is still a bit, like policy, as I mentioned, like regulation is still a bit, you know, lacking. We have been focusing more on, you know, EU, UK, North America, because there was some, you know, grants or some indication that regulation was going their way as well. Global South, it's a bit tricky because there's no indication that of like support, like policy support. And I think it all depends, again, if, you know, there's demand for these credits. Other things to consider might be operational constraints. So, but that is a bit like everywhere, not especially like Global South versus like the North. Is for instance, if you look at, you know, biochar or the, like, you know, operational constraints such as feedstock availability. So that's a quite important thing to keep in mind. You need, if you want to scale in a country, whether it's like north south, you just need enough supply, for instance, for feedstock and for some technology, and then obviously, and you know, you need some high quality criteria, quality checks. So for some projects we've seen the quality requirements was just not as high, and so it didn't ensure permanence, which is obviously a key point for CDRs. And something obvious, but, you know, like political context. In some countries, it was just a bit risky. Like there was no way we could get this approved, or, you know, there's war zone that is like not close to the project, but how, you know, what is the risk of it spreading? Obviously, I'm not saying that all Global South countries have, you know, are at war, but just we have seen projects that were in countries where there was, you know, some conflicts, and even though not in that specific area, and it is a bit tough get this approved. So I think when you think of developing a project somewhere, you have to think of a few things, like regulation, you know, obviously political situation, and operational constraints as well. I think that's like we think about these key things. The list is not exhaustive, but yeah.
Sure. And we're running out of time, so I would like to ask each of the panelists. Well, first of all, thank you for the amazing input so far. If you could, in 30 seconds, and I mean 30 seconds, give one piece of advice to the audience here of what they should keep in mind with a focus on potentially needing to raise capital in the future, what would it be? Start with you, Greg.
Never quit. That was said by somebody else, but too dumb to quit. Get yourself too dumb to quit.
Great, thank you. Linda, I'll go to you next.
I think I think the easiest, obvious answer is to de-risk the project as much as possible from an investor's perspective. Try to put yourself in their shoes and see, like, if I were to put my money in something, what could go wrong and how can I mitigate these risks? Obviously, easier said than done. I know that, but yeah, that's main takeaway.
Erica?
I think remember who the customer is. I think there's been a lot of, as investors in commodities and the developers, we're just hyper-focused on bringing supply online. Here, the demand is so critical to unlocking value. And so cautious of that as developers develop their projects. It's really in service to the buyers. So keeping pulse on what they need and want is critical.
Thanks a lot. And then Jeremiah, I'll get you for final thoughts.
Last and definitely least, there are no solutions, just trade-offs. And unfortunately, if something smells like a silver bullet, it often is snake oil. I think the reality is, markets are priced the way they are, and capital is raised the way it is because there's a lot of competition, right? For capital, we look at many projects, and we have to appease our own shareholders and limited partners, other investors, right, who invest in us. So I think the truth is there's always a right time and right place for things, and there's optimal solutions. Sometimes you have Pareto efficiency, but most of the time the hard decisions in CDR are about deciding which trade-off you want to take, and ultimately kind of making the right decision for the company. It's all unique, and we're all building a new business model together. So kind of figuring out what you're willing to accept and live with is key.
Thank you. So never quit, de-risk, remember the customer, and don't sell a silver bullet. That's what I'll try to summarize that as. So thank you so much to the panelists for sharing your thoughts. I learned a lot, and I think the audience learned a lot as well. And also thanks to the audience for being so engaging. We received so many questions as we were going on here. It was really great to hear all your thoughts as well. Maybe a couple of takeaways. Please get in contact with us if you think you're ready for project finance. We're happy to help you out. Have a look through what you have and see whether we see anything missing, or whether you'd like an introduction. We can potentially help out there. We will make a recording of this webinar available in the coming days on our YouTube channel as well, if you want to re-look at anything. And we'll quickly make a plug for our next webinar on the 5th of March, which is Carbon Removal Market Trends and Outlook for 2025 and Beyond, hosted by Layla, and including Nikki from XPRIZE Carbon Removal, Robert Hooglands from CDR FYI, Nassim Poor from the World Economic Forum, and Eva Tammer from Climate Principles. Thanks again to all our panelists. Make sure to follow them on their socials, on LinkedIn. And thank you all for joining. Please feel free to sign up to our webinar if you want more updates, and reach out to me and the team if you'd like to have a conversation, and fill out our supplier eligibility form on the website if you have a specific project to discuss. Thanks a lot, and have a good morning, afternoon, evening, depending on where you are. Thank you.
Thank you.
Right.